Hello and good morning to everyone listening in for today's Investment Talk EMEA. What's next for European core locations? In the past months, we've all witnessed a very big change process in our continent. And in fact, what has been investors' darling all around last year, the European cities, is right now bearing massive change. That change being that some cities are faring very well during this crisis and others are actually having issues competing in the investment markets. Which markets are faring well and which are competing for attention? We will find out during today's session. Welcome with me together, Mr. Matthias Leube, CEO, Colliers International Germany. Thank you for hosting this round again today and being joined by your elaborate guests who will let us know how their prospects are looking in the markets. So let me hand over to you right now, and we're looking forward to your discussion round. Please also bear in mind that you're more than welcome to ask questions during the session, and we will provide them in the Q&A session via the chat tool. This is possible all times. Thank you and see you later.
Yes, good morning, ladies and gentlemen. I'm happy to moderate this webinar today. It's about EMEA investment opportunities. Basically, Colliers undertakes over 40 webinars in this current environment to provide a platform for discussion to give a view with what might be next. I would like to welcome today with me Ali Otmar, Senior Partner and Deputy Head of Investment from Tristan Capital Partners, and Philippe Lapierre, CEO Europe at Salle Investment Management. Yesterday, we had 2 webinars with colleagues and clients about the US and Asia Pacific, very intense at the moment for us. So Asia Pacific seems to lead on managing the pandemic, while the US is still not fully settled clearly. Overall, it's clear that capital seems abundantly available, particularly for core assets. In Europe, it becomes clear that recovery is on the way. However, we are now starting again with some more stringent measures in countries after the holiday season. So I would like to start with a short presentation about the context in Europe. And I would like to start, and obviously this is a chart that everyone will know about, but it again shows that countries have dealt or had different impacts with the pandemic, and clearly that impact also had impact on GDP, but there's quite a wide range of impact across the European landscape. If we go now to investment volumes, obviously that we see that this year will be less active than the years beforehand. What is interesting here is that the continental European, the green line, as you can see, is holding up pretty well. Yeah? While obviously the global investment capital has reduced due to travel restrictions, but cross-border in Europe apparently held up pretty well in this environment. In terms of outlook, the mid case is really around 230 billion. Most buyers think that the markets will more or less stabilize in the next 12 months. I think the sentiment might change a bit due to the restrictions that are now underway. I think some of you or most of you will have seen that Expro Hybrid has been cancelled yesterday evening, short notice, and certainly that might impact the general environment. Clearly, we see very nicely a V shape in the sentiment, the red line, which is currently the scenario most economists take as the likely scenario, but we will see what the panelists will tell us today. So in terms of asset classes, I think what we all see is that certainly industrial logistics and residential are clearly the two asset classes that are most sought after, and due to that, particularly in industrial logistics, we see quite an increase in pricing. Yeah. For residential and offices, particularly for residential, I think we see a slight uptick in some locations, but overall it's like a stable environment. In the office asset class, we see stable to slightly lower pricing across the European landscape, really. Yeah, and certainly retail has been hit pre-COVID already, is certainly also hit with the pandemic, and hotels, as we can see, has been hit the most, really. Yeah. If we see a look at which cities suffer, or which cities have been clearly in the focus of a lot of the investors, we can see that particularly the German main cities have been in focus mostly. For the remaining, it's either stable or lower. So this could have something to do with how Germany dealt with the pandemic, and we will talk about this later in the panel. Now, talking about some of the key trends that we at Colliers think that remain to stay, or that will have an impact on the real estate markets. Clearly, on the office side, as we all are aware, working from home is here to stay. We are rebalancing where we work, and this certainly impacts on the office space in terms of reconfiguring it, and also in terms of where to locate, and will also have an impact on the overall office stock. If you look at industrial logistics, clearly that asset class, despite the high interest in this asset class, there's a lot of change going to happen in terms of supply chain. What we see is that most tenants and occupiers want shorter leases, because for them the environment is also not particularly clear. They don't get long-term contracts at this point in time, and this also certainly impacts on this asset class. If we now look at hotels, retail, and residential, I think the occupancy will be down for quite a while. What we clearly see is that there's a lot of renegotiating of existing leases happening, and maybe also reconfiguring of use for some of the hotels. So this becomes interesting now for a number of investors that are more in the managed to core environment. Food anchored retail remains strong during the pandemic, and there's a discussion because of home office whether large cities will keep the demand that they had in pre-pandemic going forward. So some of the key trends that are in discussion that I would like to discuss with the panelists here. Philip, maybe I start with you.
You said it all. You said it all, Matthias.
We can
put on a movie. No, go ahead.
So in terms of the trends, I think you most recently went into residential. I think as a new asset class for you. Maybe we start with that, and maybe you can give us some context there. What your plans are, and why you think that asset class in this environment is
sure
positive.
Thank you. Well, first of all, I think thanks for the invite, and thanks for having Ali and me on to discuss this topic, which obviously we discuss on a daily basis. Unfortunately, not with each other, so it's going to be interesting to hear what Ali has to say. But it is the running topic that when we sit down, both in our global platforms within my European teams, this is a daily topic, and it's a daily topic because there's uncertainty all the way down the line. in this COVID environment. And that's in the decision what asset class you want to invest into, and along the pieces what our clients want, what our fund structures and portfolio structures look like, and what do we think are the trends to come out of this, and where will we be able to deploy the capital of our clients most prudently at the moment. And the one thing before we get into the sector traits, as always with a crisis that hasn't unfolded yet, so even if you take the COVID virus out, the effects will be felt for longer, then there is hopefully potentially a solution, less deaths, and maybe a way back to normality. There will be impacts, and those impacts are what you're trying to avoid at the moment. So there's got to be a very prudent stock selecting process, and as I would like to say, with a lot of patience involved at the moment. Patience, because I don't think that the market movements have stopped yet, which means the market movements, you wait for the markets to come in your direction rather than trying to find the stock that fits the present situation. So that's our approach, and that requires quite a lot from our teams to not, push forward trying to find the one or other opportunity, but rather to wait, dig in to see what will happen. So the residential deal is a reflection of that. As with everybody else, sheds and beds is top priority. It feels there's a certain conservative cash flow being produced. It feels that it's an asset class that will fare well through the crisis, but longer as well. This isn't just a crisis situation. The residential play was something where, again, COVID for us at LaSalle anyway, it was again, it was just it quickened the pace in our endeavors to go into that residential route because our portfolio construction needed it one way or the other, and it just quickened that pace. And it quickened that pace because as an office, or 60% of our portfolio in Europe is office, and after a 10-year running grand super cycle, it was clear something was going to happen. So again, this is just another a pace quickener to a certain extent. And if you look at the numbers around office, 60% of the European market, I mean, the demand is down, varying anywhere from 60% down to 30%. The leasing numbers are, to say the least, we're back to 2009 levels, so post-GFC levels in the office space. We have the topic that we can discuss at later lengths, what are the challenges of office? So residential and logistics feels good in this environment. It's where the capital streams are going. It's where we still see, because we do see the urban trend to continue, where generally speaking, you still have a long duration of demand. There's an underlying macro need that those asset classes fulfill, and hence why it is the flavor of the month that we are looking at. Unfortunately, like all the other herd animals around us, we're all going to the same space again, which means, capital is going to start pounding yields, and you have to find a path to try to secure deals in that very crowded space at the moment. Now, there's two ways of doing that. You fund it, you pre-fund it, you go into developments, you increase your risk curve there, or you pay a premium. But nonetheless, and also, by the way, due to the great consultation of Colliers, we're very happy to have done a deal in Berlin, which fit into that strategy, and we're looking at another one. So yes, we are progressing in that deal. It's because we're convinced of the need. We see weaknesses in offices, which hasn't repriced yet. We see the need for logistics, especially urban. We'll wait for retail at the moment. We're risk off very much on the retail piece. And on the hotel piece, we do believe it's going to be the one to bounce back quickest, but it's certainly not yet. Again, patience is one to look at and to start analyzing which operators will be there for the long run and what hotel type will be the one to be sought after. What's going to come back first? Tourism, business? It's a bit early to be underwriting those scenarios, but you can obviously look at which operators will work. So that's just a quick overview of where we stand, and then it's all down to details and different cities, but I think we'll get into that.
Yeah, thank you, Philip. Ali, you most recently acquired a portfolio of offices. Is that your main focus at the moment in terms of asset classes, or what opportunities are you looking at in terms of asset classes across the board?
Absolutely. Look, we're a value-add investor. As a result, unfortunately, our job is to really have conviction and take views, and this is why we think we're getting paid for. Having said that, the COVID-19 has actually really caused a cyclical pricing reset across all European real estate markets, and I would argue, with the exception of logistics and residential, across all asset classes as well. The market right now has really been dominated by two forces of risk aversion. One of them is risk aversion by core investors, which is an opportunity, and the other one is risk aversion by banks, which really impacts the availability of debt financing. And these two forces actually create a very attractive environment for our funds, which operate in the core plus and the value add segments. In summary, if I were to always summarize our business model, we buy properties with correctable impairments, we fix them through intensive asset management, and then we engineer core properties to sell to the likes of Salle or other core investors. And in doing so, actually, because of COVID and because of what is going on in the market, we're today probably facing less competition for those impaired or a little impaired assets in this case than before. Typically, the competition for assets came from core investors that were, really reaching higher in the risk curve in order to get the returns they are targeting, and it was also coming by value add or opportunistic investors purchasing, core plus assets with very high leverage in order to engineer a value add return. And as I mentioned, because of the risk aversion by both core investors and by the banks, and therefore availability to value add investors is fairly limited, we're seeing a good market environment in which we invest in. This means we can effectively charge higher margins for fixing impairments. We operate in a actually quite healthy exit market where liquidity for core properties still continues to be substantial. And that's because of the ultra low interest environment all across Europe, but all across the globe, really. And what we see is that once you have the right product that ticks all the boxes of the core investors, there is actually still more than a handful of buyers in order to create competition when you're selling assets. But on the buy side, we really are not an extremely high levered investor, so we don't really see the risk aversion of banks not wanting to lend, and we see less competition from core or certain investors that were really doing more core plus and value add investments. Mm-hmm. In that sense, it has been quite a good kind of investment environment for ourselves. And yes, we have invested in logistics and we have invested in residential in this period quite substantially. We actually have a slightly different way of approaching it. We have local platforms, both on logistics and residential in Netherlands, in Spain, and in other countries, whereby we buy literally 10 million lot sizes in order to bulk it up. And this has been somewhat an opportune moment, but not nearly as good as some of the office transactions we have done. And with regards to the offices, I think you mentioned obviously the large portfolio we have acquired from AEW. For us to invest in offices, the criteria at the moment is twofold. We should either be accreting to the overall physical and location quality of the portfolio of assets that the fund owns. So we need to be buying better location and better physical qualities at the same return as the fund's target return, or we need to be paid an oversized return for taking office risk today. And I would put actually the AEW portfolio, which was largely, I would say, half of it really core locations and core properties, both physical and location and leasing profile, and then maybe core plus locations, but with a core leasing profile. The portfolio is 100% let, somewhere between 5 to 5 year WALT to break to 10 year WALT. And as a result, it has really allowed us to improve the overall quality of the portfolio that CCP5, our core plus fund, owns.
Okay, thank you, Ali. You mentioned financing, and obviously that has been something that most recently when we had our earlier talks, Philip and Ali, has been more difficult. Has this changed for you? I mean, has financing become again easier? And did it remain on the same LTV levels than we talked about a couple of months back, or what's the situation for you now? You know, for that portfolio or other asset classes to get financing.
Sure, Ali, you want me to take it up? I'll try to keep it short. There's two elements there. In the last 3 months, has it gotten easier? No, it hasn't gotten any easier, of course. But depending on your asset type, and Ali already said so, you know, if you don't overextend your leverage, I mean, the value add space has gotten less. There is less appetite for value add. Now, I would assume that in the value add pieces that we do approach, or the end side of the core plus piece, you know, we've been doing that for a long time. So there's standing partnerships that you can now actually build on. So it does kind of put you into a more unique position than some of the other players that Ali mentions, but it is a less crowded market space. So, and the banks know that, so they'll want their premium to go into that risk class as well. That's the one side. If I look at our equity business, on our debt business, if I look at Amy Asnar's business, you know, that's obviously getting a lot of attention at the moment, and there's a lot of approaches for her to stock select on what deals she would like to follow. So you can see on her side that the banking, the classical lending system is held back, which provides her with opportunities. So thankfully, we have both sides of that platform. So the activity that we're seeing with her, we might have a little bit less on the equity side. Essentially, I mean, we're still in a low, long-term, low interest environment, and it's just a question of margins at the moment. And margins also reflect stability and the partner quality for a bank just as much as the cost of debt itself. So I think getting into that, it's stable on a higher level than it was pre-COVID, and it's focused on the core deals with long income, ideally. And then as you go up the risk curve, the amount of debt being supplied becomes less, and then it's down to your track record, your partnerships, etc., to provide that, which is great because it's a normalization of that market piece where it should be. It was getting very crowded, and I think value add returns, or core plus returns, or core returns the way they used to be, core plus returns, where the shift along that was getting quite scary, and everybody was going into value add at returns that really didn't reflect that risk. And that, as crises go, I think the core piece will be squeezed. So Ali's absolutely right. If you can get your hands on assets that you can restructure and put into the core market, that capital stack there is very deep. If you're one of the few people who can generate that, especially if you look at the amount of developments being pushed back in this market, in the office sector anyway, yes, there is increasing vacancies, and there is increasing, but even with the pushback developments, if you can access great stock in great locations and get it leased, which I find is the biggest challenge, and your return reflects that, the markets are ideal for that. Less crowded on the value add and very crowded on the core. Should be perfect for Ali.
I think in the case of financing, maybe one caveat that I would add is there is quite a bifurcation of the market. So I would say we have two funds, a core plus fund that takes 45-50% leverage, and a value add fund that takes, let's say, 60-65%. And I would say the margins drifting in Germany was somewhere between, really across both strategies, 10 to 20 basis points. But the same thing has probably drifted about 100 basis points in the UK. So there is quite a different kind of level of availability of debt across different jurisdictions. And I would put maybe somewhere in the middle, 30 to 50 basis points France, and then 60 to 70 basis points Spain, etc. So the type of really the ample financing that we've had across all the jurisdictions is probably now only limited to Germany, and then it's drifting away as you go farther, I guess, west.
Okay. Ali, a question there, but have you seen that repricing on the market yet? I mean, we're working in the same market. I'm assuming we're seeing all the same deals to a certain extent anyway. And I haven't seen the repricing to accommodate my higher cost of debt, my lower releasing scenarios, higher TIs, lower rental growth, etc. That hasn't filtered through yet. I mean, there's still not huge amounts of pressure, on the sellers out there to accommodate that different pricing. It's coming, and I think as the the horrific demand numbers and leasing numbers come through, that might change, and banks might be getting a little bit shifty in their seats and starting to push on their borrowers. But have you seen price corrections in a bigger sense come through in the value add space? I mean, it's obviously not there in the core, but in the value add space.
Not in the bigger sense. So in the first few months of actually COVID-19, we've had almost better pricing for value add assets, because in March, April, and May, we were the only people, and if you needed liquidity and had to sell, then you had to accept the price that we have offered you. And we could really, punitively underwrite assets in terms of void periods and even cap rates, although I have a positive long-term cap rate view, and costs of tenanting, etc. Whereas in the middle of it, when more and more markets have opened up, also more stock was on, actually it has probably swung again a little bit more in the favor of the type of people who sell assets that people want to buy, let's say. I completely agree with you that probably the biggest wave of pricing correction, whereby we can really reflect the reality of what is yet to happen in the economy, is going to be probably somewhere in the first half to middle of next year, rather than now. Because a number of, one thing that we're so focused on COVID, we're actually forgetting that we have put the world in an induced recession. All the corporates, the furlough schemes, it is inevitable that a large portion of that will actually convert into permanent redundancies and not only temporary. All the liquidity that is being pumped, sooner or later, we're going to run out of it. And then we will really see the real impact on the economy in almost a second wave of GDP contraction.
Yeah, hence why a bit of patience, because it's coming one way or the other. To be able to price it correctly.
You're seeing quite an extensive wave of new asset coming to the market. So my analysis is really that in August, September, there was a starting point when assets came to the market more and more, and now we are seeing basically that those assets being held back during COVID are now coming to the market in terms of, and coming back to your point, Philip, being selective in this environment, that now you have more choices to make at the moment, plus the situation that really global investors are not yet back to Europe because of travel bans. Is that an environment you currently see, that you have more choices to make, and that has become easier for you to really win transactions?
Well, my question there, if I may, Ali, the more product comes on the market, it also means that somebody's calling the office market, from their perspective at least. And again, it's that opaque situation, in particular around office. So you've got to differentiate the asset classes and the risk types, of course. But generally, the office space is the one that, because it's such a large part of our industry, that it plays a dominant role, and its like or dislike in that space plays a dominant role of where capital flows go. And I think we're all just pretty uncertain. Everybody has a view, but pretty uncertain where that segment is going to head. How heavy is that compression going to be on the demand side? Is that a long-term demand issue? Is it a short-term? Even the short-term, we still don't know which insolvencies are going to come through. We don't know what the subleasing market's going to look like. We don't know where the pressure is, which techs will stay on forever. We don't know how many projects will have been pushed back to really reduce the potential supply coming in. And then you've really got to differentiate the different markets. If you look at potential supply, there's some markets out there that kind of scare me, in the sense that there's so much held back demand that the rental decline can be quite heavy. And with that, also, as always, in its double impact, also the outward yield shift. So the environment to buy office at the moment, and the amount of product coming in, to me, that's always the beginning of a outward yield shift, essentially, and crumbling parameters to buy into that. And early in the phase, no correction of that pricing to reflect that risk. It doesn't matter if there's the potentially aging capital missing. There's still enough capital out there sloshing around to cover those bits and pieces. And some people will make that call and think it's a great call and maybe even confirm that pricing. But in the mid to long term, all that does is blend out the potential evident piece that around office there is a challenge there. There's a structural challenge, and we just can't judge it. So I would expect a lot more return around that risk, and the risk is not knowing where it's heading, which is potentially the same risk that was there pre-COVID, because you never know where things are going to go. But you just have COVID now, so you want to bargain in on it. The other asset classes are a bit different because there's structural underlying sensible strategies that you can see around consuming, around living, and you can't solve the office issue without the resi issue. So even if you assume everybody works from at home, you got to solve the residential issue to enable that for the office piece. So I like that structural piece. I like betting on that more than I do on a short-term potential of stock being there. Like I said before, and that's a long answer to a very short question of yours, you've got to be patient. And if you want to attract alpha, stock picking is even more crucial at the moment, if it's a driver in one way or the other. But still, 21 will offer opportunities. It's going to be, 21, 22 are going to be potentially good vintage years again. Because let's be serious, beginning of 20 pre-COVID, I don't know, I just found it all a little bit overpriced, very crowded. Say what you want. A little bit of shake-up isn't the worst thing.
Core office and also industrial logistics have increased, and given industrial logistics now with all the issues in terms of change, they have.
Doesn't mean because it's happening that I agree, by the way, Matthias. It's not that I like it. It happens. It doesn't mean I like it. But go ahead. Sorry, I interrupted you.
So I mean, in terms of we haven't really touched on countries yet. We have talked mainly on asset classes. Any countries you prefer in this environment, or you don't touch, or where you see most opportunities? So we've seen that some of the cities, basically German cities, are really continue to be sought after. Do we see now opportunities?
I truly hope Ali says Germany now, otherwise I'd be surprised.
No, I would categorize it first as follows. Our immediate reaction is obviously to retract to countries with greatest liquidity. And those would be Germany, UK, and France in Europe, being the largest commercial real estate markets. But then when it comes to probably the UK, it's facing substantially more and different challenges as well. And therefore, I would say if you were an investor just taking real estate exposure, Germany is and continues to be your safest bet. The way we talk about Germany and the office is as follows. There is a global recession going on, and all the countries had to pump in so much money and liquidity into their economic systems, both fiscal stimulus and interest rate stimulus, etc. However, Germany is different in the sense that they are putting money that they actually had. All the other countries, they didn't have the money, and they are putting the money they don't have. So in that sense, if you are a long-term investor, a core investor, I think you would definitely feel safest in Germany. For ourselves, which we are a value-add investor, and frankly, our job is to make calls. Hopefully, more of them turn right than wrong. I also believe that throughout the next 12 to 18 months, London being such a high volatility country, high volatility city, is going to have its ups and downs, and there might be good points to enter City of London and these kind of larger office markets. And I would at the same point, to a certain extent, also for La Défense in Paris. I think not immediately, because there is a whole bunch of construction activity going on, but somewhere probably in 18 to 24 months, it might be a great time again to be entering markets like La Défense, which historically have exhibited volatility.
So at the moment, you're not touching those markets. You're waiting a bit up until the market has repriced.
Absolutely. So far, really, we have been focusing, I would say, on the office side. either extremely core locations in larger cities. We have both, for example, an office building in Madrid, but it's really a core building that we have acquired at a core plus pricing that we, in other market circumstances, would not have been able to secure. And the rest of our entire office exposure has been in Germany, I would say. But Resi and logistics, we've been buying, let's say, less selectively, more across different European markets.
And you haven't at all mentioned hotels. Yeah. Do you see, I mean, an opportunity? I mean, you are value-added investors. Do you see an opportunity in this segment in terms of?
No, absolutely. I think hotels, hotels and retail are the two frontline industries that have been obviously hit most by COVID. I would say retail, we would probably continue to sit out because there are a lot of structural challenges in addition to COVID challenges. And by the way, also now economic headwinds, given that we're entering a recession with increasing unemployment and lower salaries. It's not a great time from either structural point of view or from economic cycle point of view or from COVID point of view to be entering retail. However, hotels is probably likely to recover quicker because there are, in my mind, no structural necessarily changes to the hotel market. It has recently been introduced, and the economic activity should recover hopefully soon. Having said that, you have to be quite discerning in terms of what hotels, what type of hotels you invest in. Probably business travel, airlines as well, if you're airline investors, is probably the one that is likely to come the last back, because given that we're in a recession, I see very difficult that your average industrial company is going to send an engineer to take a plane, go overnight in a hotel in a different city in order to meet a client the following day, which they will never see again, and then come back. You know, that kind of travel is less likely to come back in the near term, probably mid to long term when corporate profits recover. Whereas I think resorts, for example, I was in Sicily over the summer, and the resort was 100% full. Not only it was 100% full, all the restaurants were full because nobody was leaving it. So there are types of, let's say, hospitality sector that are likely to come back first, and others that are likely to follow.
Okay, Philip, your pick in terms of countries and cities.
I'd love to say something different than Ali just said, but I mean, it's your obvious picks. It depends on your equity source, of course. Germany won't provide you with the huge IRRs, but you know, maybe risk adjusted is still probably the best platform to be looking at, or best country to be looking at the moment. France follows a hot second, and I agree with the UK. You know, the one piece I'm always missing, everybody loves London, but the UK has a double whammy coming, both COVID and Brexit, and both of them without a clear end of what it's going to really impact and what it is. And you then have the quality of life and a fantastic global city like London that might just be enough reason for people to come back and for it to have its rightful existence. I agree with that, and opportunities will arise in London. And long run, you know, there's no doubt London has a long run justification of being there. The other, Spain, which I personally love as an investment market, but on the one hand has always kind of underperformed its promises somehow. Everybody always expects masses from Spain, and then it kind of disappoints in the medium to long term. I mean, love the country. Hope there's no Spanish listeners right now. But it's a challenging piece, and again, even COVID there, and as Ali rightfully put it, Spain is definitely not spending money they had for this recovery. So again, it's going to be a long, drawn-out recovery there. You can see it in the rents already. I'm just looking to my right here, where you see the rental adaptations in Barcelona and in Madrid, and they are not good, and they're immediate. They're already there. And we haven't even gone down the route of, let's see what actually comes out of this. This is just immediate reactions. I do like the Nordics. I do think that Stockholm, on the other hand, will correct in pricing, especially on rents, because it's just gone stellar. It's just gone way too high. So there's a correction need there, but there is again a uniqueness around Stockholm that makes it attractive. as the most central piece within a stable Nordic region. Amsterdam, I find, is an interesting one. So the Netherlands, I look at cities, not countries, to tell you the truth. The country piece, yeah, is a tax level piece. And Amsterdam will be an interesting one. I mean, it's had a great run. It's great improvement, great quality of living, all the things playing for it. But also very, tech driven to a large extent. I don't know how much space booking will sublease and what that follow-on effect is. And if people come back to Madrid, it's like the Dublin Causa. How much, of the people who've moved there to be with the techs who've gone back home, are they going to come back? If they don't come back, that cycle of you can't just stop these buildings and pick up cycles. So again, it's Germany. CE we haven't touched on. Warsaw is certainly a tricky one, just because you can just keep supplying, and this is where it comes in. Even though the absorption was fantastic, but you take away that absorption. And I find it might have a multiple impact there. But the numbers are actually looking quite good. It's looking stable. The TIs haven't gone up to the extent that other countries have. I'm just looking Amsterdam's, up 3, 4, 5% already. So that's a bit worrying. So on the office piece, Germany, on the logistic piece, it's the corridors you have to look at. And then the more exciting question is urban or motorway, and where's your rental growth? The driver for the incredible yields that we're meant to be paying now for whatever stock is out there. So the differentiator there is city proximity to yields. How does that behave? And residential, again, it's the urban trends. So offices, Germany, residential, I'm a bit more broader because it's a natural trend that will come back across Europe, across the attractive cities. Logistics, I tend to get more picky at the moment, because you have all this capital pouring into what is remaining as an asset class at the moment. And if people don't want to go into office, they don't want to go into retail, they don't want to go into hotels, they're all hammering residential logistics, and that might just over exceed some of the risk returns that people are willing to accept at the moment. So development is really the only way in to capture some of that growth and position that. And other asset classes I would love, but are just too small. They're just small fragments still. They have the alternative pieces and more challenging. I'll leave that to Ali.
Very good. So thanks for that. I was thinking about, there she is. Yeah. Hi, Juliane. I was thinking about what the forum thought about our conversation and in terms of what kind of questions we have at the moment.
We had quite a few during your discussion, upon some of which you already touched in your debate, but let me just reiterate if you feel that you might want to add something. For instance, in the very beginning of your debate, one of the participants asked, given the huge uncertainty around economic performance and the apparent sustainability of remote work, can office pricing really stay stable? I think you've gone into this quite at length. Is there anything that, adding to what you've already said, that you would like to put forward at this point?
Perhaps, I mean, to reiterate, I think everyone on this should really be saying the following. There are people who know they don't know what is going to be happening structurally, and there are people who don't know that they don't know, and hopefully we all agree that we should be in the first category. Having said that, it's again not a uniform thing. So if we take Amsterdam, which is also an office market I historically loved and probably continue to love, is actually very different trends compared to all of the other countries. If you look at the Netherlands, 34% of the workforce regularly worked from home pre-COVID. And if you look at the Dutch government, which is the largest office user in the Netherlands still, is actually had already 8 square meters per employee per desk space of office space, and more importantly, they already had 1 desk for 2 employees. So in that sense, I think the impact of working from home and changing trends, which is going to be some, is going to be also varied between different countries. We have done a survey, for example, and Germany was actually the most rigid one in terms of how employers believe working from home trends will take place. It's the least forecasted actually to be working from home in Germany, and it's the most forecasted, and it was already the trend and was already happening in the Netherlands. And therefore, I think the best way, especially for core investors, is to wait and see where the chips are going to fall before taking, let's say, definitive views as to what is going to happen.
And maybe just to add, maybe just one thing to add, and I fully agree with Ali. You know, you've got to select your pieces at the moment. One thing people forget, they go black or white. It's either on or off. Even if you say that I'm looking at a 3-day week in the office, you still have to plan for your maximum peak. Yeah? So you're not planning for the Friday where there's only 10% in the office. Am I still on, or did my audio just go away? Yeah, because I'm getting some alerts here, maybe because they don't like the content. So you've got to watch. You know, everybody will plan for the peak. Yeah? So you plan for that Tuesday, for that Wednesday, Thursday. You cannot plan for the 10% that are in the office on the Friday. So the impact there, you know, that might just be a little bit of hindering that. You know, we're not going to have floods of empty offices, but there's challenging times ahead for that office, for that asset class to adapt to what the tenant needs in its flexibility. And there might be, you know, a drag on that stellar growth that we've had in the last years, and just be very specific on what you buy and the quality that you buy. For the core, for the value add, find that gap.
Just to make that clear, there's no censorship in this round. Okay, moving on.
Sure.
I've got quite a lot of questions remaining, so let's tackle this. You've already spoken about pricing for value add properties earlier, also at length, and about the spread to core plus, that it has narrowed, and the fact that you actually don't see much repricing just yet in value add opportunistic. Is there anything, or do you have some points where you would maybe see some, and would you be able to name one or two on that respect? Ali, is that something I can hand over to you, because you touched upon this earlier?
I think as I mentioned, we have actually been quite active in the third quarter. I think we have invested somewhere around 380 million of equity in the third quarter alone. But all of those were transactions that were effectively started at the beginning of COVID and kind of progressed throughout COVID. And that has given us quite a bit of benefit in terms of pricing, because in September, I actually took a plane and flew to Berlin. And I have seen 3 or 4 of my competitors in the plane. And it was their first time traveling since March. Whereas Tristan, we have a slightly different model. We've actually had people on the ground in Germany and in the Netherlands and in Spain and in France. So our activity kind of continued throughout this period because we had local people, and different local markets have also opened up. I mean, since middle of May, you can probably have business meetings, and offices are still to a large extent occupied in Germany. Similar story in Netherlands. Netherlands, throughout COVID, if you actually did schedule a technical site visit, you were permitted to be outdoors. And so as a result, business activity continued at the beginning of COVID, which has been an advantage in terms of pricing. And now there are more people on the street. It's unfortunately not as good as, let's say, it was in April and May.
Thank you for that. Actually, speaking about Germany, that's a good handover to the next question. Are there any big German markets you currently prefer in office in comparison to others? Are Munich, Berlin still everybody's favorite? One participant is asking, I suppose that goes back to what you said, Mr. Pierre, earlier on the topic of technologies, and if people are going to come back to the cities. How do you evaluate the big German cities at the moment?
My preference would still be Munich and Berlin, and my least favorite probably Frankfurt, but that's a typical demand and supply question. I don't think that, you know, a potential hard Brexit London exodus, simply because you can't compare those two cities, will absorb the supply that's coming in on the Frankfurt market. So it is, I find, the most volatile, and for me the least attractive of the attractive. So let's, you know, before I get hate mails from anybody who's loving Frankfurt, so let's, you know, it's still on a high level, everybody. But I do prefer Berlin and Munich. If you really ask me if I was a core investor, it's Munich. Surrounding Munich, I mean, again, you know, you read Munich, you hear the highest residential bubble in the world. So there are some areas around it that make me feel uncomfortable. And Berlin, my only issue is you have an underlying need. You still have a great city. You still have a cost of living that makes it competitive, but it's being squeezed. So it's got to be careful in that context. The supply is still minute to comparison to the demand that was there. So I do like those dynamics. My only issue with Berlin, and nobody's been able to answer that question, is those higher rents that were being paid by the Zalandos, by the WeWorks, by some of the tech operators out there who might just become under pressure now. So that very high peak of that market, I would be careful. I would prefer looking at that mid piece, because again, like in Amsterdam, the biggest users is still the government, and I'd look at that segment in a core plus location or in a CBD fringe location in Berlin. That would be more my pick than the core high priced rental piece that I think might come under pressure. In Berlin particularly, that it just went so fast.
Mm-hmm. Right.
From my point of view, I only care about what Philip thinks, because he's going to buy the product we're going to manufacture.
Make it look nice and shiny, Ali.
Well, that's sounding good. Right. Something we also touched upon, but maybe you can go more into detail, Mr. Leube. How do you see the bid-offer spread in the various sectors and sales? They're currently marketing by market sector risk profile, and how has it developed during 2020?
So I think what we certainly see is that core investments have a high attention, and also achieve in some parts higher pricing than beforehand. Yeah, what we clearly see is, or saw in Q3, is that we had somewhat lower attention than beforehand, because the international capital was missing. This is not anymore the fact. Yeah, so when we are going out now with core product, we we just went out with a core product in Hamburg. We achieve quite a significant amount of interest. Yeah? In terms of that, I think the core segment is clearly a segment that is absolutely sought after, and you don't have any kind of impact. Yeah. When risks, when it's connected to risks and maybe also things that get ready now instead of get ready in a year. Yeah. People start to feel a little bit uncomfortable. Also, they start to be a little bit uncomfortable when a development is ready in 2 years, for example. Yeah, so because they really don't know where the market is going to play out. Yeah, and they don't want to pay over in that context. Yeah, so but still, because there is so much capital around, and even without the Asian capital, we don't see really issues in terms of repricing yet, as the two panelists also said. And I think clearly a lot of people debate it at the moment, but nobody knows. Yeah, so everyone continues to be focused on product, because they haven't bought as much. Most of the investors haven't bought as much during the pandemic phase, and now wanting to spend the money that is sitting on the accounts from their investors. Yeah,
I think that's crucial, Matthias. As you said, some of the investors are spending their money. At LaSalle, we like investing money. There's the big difference, maybe. Yeah. And we're not the core buyer. Maybe just to correct that, we're much more on the core plus, and the highest dry powder we presently have is actually more for core plus value add product. But again, I come back to that patience piece. The markets will move, and I think those areas will come up. So that would always be my advice: don't run and spend, wait and invest.
Yep, that actually answers one of the questions that came up again. It said, how do you see the differential in financing yields between core plus, and value add, and how have the margins moved due to COVID? I suppose patience is the answer to all of that. Does anyone want to pick up on that other than that? Because otherwise I would zoom out. We've got quite a few questions on other European markets still. Sure. What about Belgium looks for investments? Attractive ? would like?
Luxembourg, absolutely, from my side. Belgium, I'm kind of on the fence, but I like Luxembourg.
All right, Ali?
I think from our point of view, it's they are actually, Luxembourg has good solid fundamentals in terms of supply and demand, and the way that tax regulations in the world are going, you always need to have more presence and more people, which obviously calls for more office stock. I don't think risk developments and stuff are very low margin in Belgium and in Luxembourg, so difficult for us to really compete. It's not a logistics market, and we don't really invest in retail, so it's pretty much then offices, but could be interesting from time to time.
Right. Nordics, one last stop in Greater Stockholm, Copenhagen, and Helsinki. How do you see the liquidity going forward? Mr. Lapierre,
Ali, do you want to kick it off? No,
yeah,
let Ali kick it off.
I mean, we have been invested in Norway, Finland, Sweden, as well as Denmark. The latest one actually we have just invested in a forward purchase of a residential development in Denmark, and it's I think it is a good market with a lot of also local liquidity, which is always a healthy place to be in. So not all the liquidity is foreign imported, and therefore has to be invested in the Nordics. That also makes it sometimes probably more challenging, but if you find the right opportunities, then there is definitely investor demand in the core product. The best example is we're actually put a office and kind of retail or leisure restaurant use on the ground floor in very center of Oslo, and we actually are in the process of giving exclusivity without even finish the marketing process, because of the number of offers and interest that we have already achieved in that process.
Just to add, the Nordics over the years has created more and more local capital, and local capital means higher flexibility even in downturns. So as the capital flows recede, you need national capital, for that liquidity, for that stability of your deals. And I think all of those regions, or all the countries in the Nordics, have developed into that. So I think it's a more on the core spectrum of the countries.
Thank you. I've got two last questions, so let's try and tackle those as well. Jason Lee from the Asia panel yesterday is asking, do you see logistic yields to remain low for a long time, or the yield spreads for logistics will eventually expand back when things get back to normal?
I believe that logistic yields will be compressed for a longer period of time. I do think there will be a differentiator between locations and motorway and urban and regions. I think there is a differentiator. I think because land construction, is what we do essentially, and that's the downside of logistics. There's always the potential, if you're looking for jobs, as unemployment grows, every region will try to counter that with, building permits. So that's always the challenge with logistics, and there's a certain natural limit to where it should be, but its structural dependency, until technology disrupts that in the mid to longer term, there's a long ride still ahead for logistics, in my view, with urban proximity outperforming motorway, probably, even if there's onshoring now, etc. But the consumer bit will probably outperform the motorway locations.
Right. Okay. Having bearing the time in mind, I think we'll go over to the wrap up, but we'll answer your questions afterhand via email. Thank you for your vivid participation. Mr. Leube, just a quick wrap up of the session.
Yeah, happy to do so. So I think now having the round from Asia yesterday morning over to the US and Europe today, I think what is clear is capital is abundantly available. I think financing continues to be available, but still not back to the same levels as beforehand. Yeah, I think people need to adjust to that, and pricing hasn't really impacted in that context yet. But investors overall expect that some repricing, particularly in the office segment, might happen because of the environment of, you know, pandemic, home office, and economic situation. Might happen. It hasn't happened yet. Yeah, it might do, and that's currently what people think about. I think you certainly have some investors that are in this environment continue to be very selective, but personally, and I think also the same applies to Ali, I think this environment provides for quite a lot of opportunities, particularly if you go down the risk scale, yeah, and not concentrate on the pure core segment. Yeah, and the theme is clear around the world. Resi and industrial logistics clearly are the asset classes that are strongest. Yeah, and also you can feel there that there are price increases in those segments. Overall, I think sentiment is positive, but clearly everyone looks at the starting stringening of measures across Europe. Yeah, so and flavor for all investors clearly in Europe remains Germany. So it's a good bridge for our next webinar this afternoon at 2 o'clock, Juliane. Yeah, so for those wanting to come in and have a little bit more focus on that country and the cities, we would be happy for you to join us. Over to you, Juliane.
Yeah, thank you. It's been a great debate. Thanks to all the panelists and obviously to the participants for all your questions. Like I said, we'll be getting back to you, to those that are still open. Yep, a great handover to this afternoon. We will be having a true homecoming discussing German markets together with Arndt Buchwald from Quantum Immobilien, Philipp Schaper from Patrizia, and Henning Koch from the Commerz Real. So there's as much knowledge as we had this morning. Thank you so much to all of you again, and hopefully we'll see you again at 2 p.m. CET. And yeah, sign up is available online for free as always. I'll see you then. Thank you.
Thank you. Bye-bye.